Hey everybody, this week we're going to try to take this podcast in a different direction. I want to speak directly to your customers and your clients, people who are getting involved in a real estate transaction. Because there are certain questions that come up from time to time that they have questions about, and it's something that you all, RE/MAX Results at Sales Executives, reach out to me with questions about, so I just want to try to help give some information about these particular topics in this podcast or in this format so that they can get this information directly. This podcast is for our clients. Hi, I'm Ed Kaiser, General Counsel for RE/MAX Results. First off, on behalf of the whole RE/MAX Results organization and our business partners with Results Title and Results Home Mortgage, we want to thank you for choosing RE/MAX Results, for working with our sales executives, and supporting you in your real estate journey. Over the course of your real estate transaction, you're probably going to have certain questions about a variety of things that might come up in your real estate transaction, but there are all certain legal concepts that are really tough for a lot of people to wrap their minds around sometimes. And if I can help as general counsel for this company provide you some additional information, that's what I'm going to try to do today here in this recording. Please understand that this information is just educational only. This is not intended to be legal advice or to create any kind of attorney-client relationship. And of course, if you want to seek specific advice or have further questions about any of these topics, consult with your sales executive first, or feel free to consult with your own attorney as well. But hopefully you'll find this information helpful. The first topic I want to talk about is wire fraud. And if you listen to nothing else in this recording, please listen to the information about wire fraud, because it is extremely concerning. And I really want to make sure every one of our customers and clients understands the threat that exists all the time in relation to this growing problem. Wire fraud, cybercrime, and email malware is a plague in our digital world today. In 2022, the FBI received over 21,000 business email compromise complaints, and the adjusted losses for businesses and individuals who suffered those compromised emails was over $2.7 billion in just 1 year. And in 2020 alone, over 13,000 people were victims of wire fraud in a real estate transaction in the United States of America. And they lost, those groups of people in real estate transactions, over $213 million. These scammers, these criminals know that real estate transactions are a great opportunity for them to try to steal money. So they actively target real estate transactions. And to be completely honest, folks, they're trying to find people like you in the midst of a real estate transaction so that they can try to steal your money. It's a growing problem. And for our part, the real estate industry and here at RE/MAX Results, we have taken lots of steps to try to secure our digital infrastructure. But the things that we do, whether it's at Results Mortgage or Results Title, we can take certain steps to protect our digital infrastructure, but it's not enough. It's just not enough, because these hackers, they are attacking a real estate transaction in every possible angle. They're searching social media. They are searching public records. They're doing everything they can to try to attack us. And again, the losses, the amount of attacks and the amount of losses we are seeing grows every year. The problem gets worse. The best thing we can do is try to arm you with the knowledge to protect yourself and to protect your money. So the first thing I want to explain is just one example, but a pretty common one, of what happens in a wire fraud hacking scheme. And what happens is these hackers figure out who you are. They figure out the consumer, the person who'd actually be wiring funds in a real estate transaction. Again, they might target other transactions as well, but they know that wiring money happens in connection with a real estate transaction, and they in particular know that wiring large sums of money can happen in a real estate transaction. So that's why they're targeting your real estate transaction. When they figure out the names of maybe the agents involved or the consumer loan offers at some point, they'll either try to hack into someone's account and use it to send a false wire instruction, or what the more sophisticated ones are doing is they're creating a fake email account that's designed to trick you to make it look like it's the other person's email account, a loan officer, for example. And so if you get an email from a loan officer, or you think it's your loan officer, and it tells you, hey, you need to wire money to this address, wire $100,000 to this account, they're trying to trick you into sending money where you're not supposed to. Sometimes, by the way, you never even signed up to wire. Sometimes they'll say you need to send this money now, even though the closing's not for another month. Those are huge red flags. You don't have to do that, right? They're trying to trick you. Often they're going to try to make it seem like there's some sort of important impending deadline to give you a sense of urgency, to make you just run down to the bank to wire money, instead of taking a minute to say, wait a minute, why am I doing this, right? They try to create that sense of urgency, try to say, look, you'll lose this transaction if you don't do it right now, to trick you into wiring funds where you're not supposed to. And so these fraudsters are doing all kinds of, they take all types of tricks. But what they typically do, and what they really can only do, is send you emails or maybe text messages, because they may be able to mirror or spoof or create a false email account that looks like someone else's account. But what they can't do is pick up the phone and call you and sound like the person that you are, or that you're supposed to be speaking with, or convince you that they are the actual person, your realtor or anyone else. And so some of the best ways to protect yourself from wire fraud, number one thing, and you'll see this in warnings in our contracts and everything else, do not ever wire any amount of money in your real estate transaction unless you speak to your realtor first. Pick up the phone, call your real estate agent, and ask them, is this what I'm supposed to be doing? That is the number one way you can protect yourself, is just by picking up the phone. Because your realtor probably will tell you, what are you talking about? You don't need to do that. Or if they do say, yes, that's part of the closing, then the next step would be to say, okay, let's work together to make sure that the instructions that I've received are accurate. And if you speak to someone over the phone or in person, we are able to determine very quickly if the information is accurate or not. A few other things that you could also do, by the way, to protect yourself from, in this situation and in any other potential situation, is, for your own sake, make sure your personal email passwords change every once in a while. Engage multi-factor authentication on all your accounts. Multi-factor authentication is that thing where when you sign into a new account for a new device, you get a text message or a phone call to confirm that that's approved. That secure your personal your accounts almost more than anything else, because it will trigger and let you know if someone's trying to access your account from some other computer in some other country. So you can protect yourself, and we do see consumers themselves who get hacked, and their own compromised account is how these hackers and scammers get into a real estate transaction and try to steal money. Another thing to be very mindful of is be very suspicious of any last minute changes to wiring instructions. Very rare that you would actually need to change a wire instruction at the last minute. The banks that are usually, or the closing companies that are primarily transferring funds, they don't change their accounts very often, if at all. So especially any sort of last minute or unexpected request to wire funds, you should be very suspicious of, and you should immediately pick up the phone and call your realtor. Don't engage with email, because if they're engaging with you with email, that's them trying to trick you. Pick up the phone, call your realtor, and then follow up. If you do have a closing and you do have a wiring of funds, which, by the way, is optional. You don't have to wire funds. If everything you're hearing about this says, I don't want to deal with wiring money, that is perfectly fine. There are other ways that we can either bring your proceeds to a closing, or you can take the sale proceeds from a sale after closing, and bank checks, certified checks, often routinely used in real estate transactions. So if you prefer the protection of a paper check versus a digital wire, go ahead and go with that option. That is entirely your choice. Don't let anyone tell you, that there aren't other options, because there are other options. If you do wire funds, follow up. Once you do send a wire, make sure you talk to someone. Typically in our closings at Results Title, you will receive follow-up information, everything else regarding that wire and everything else. But if you do ever feel at any moment like something was about that email was suspicious, something about that didn't sit well with me, follow up with your sales executive, follow up with your realtor, and make sure you did the right thing, because there's about a 72-hour window where it is possible, if we engage with the law enforcement, FBI, and the banks, that they can pause, freeze money, or pull back a wire if there was a mistake or a fraud. But that window is about 72 hours, and it closes quickly. So be sure to act quickly if you suspect you've been compromised in any sort of way. So I hate to be the bearer of bad news in bringing you this information. We do have wire fraud warnings and other things that are part of our contracts that we do try to provide to you as consumers. But I just have to be abundantly clear that this is a growing problem that's not going away, and the best defense that we have against it is knowledge. So I hope this information is helpful for you to protect yourselves and your money from wire fraud. During a real estate transaction, as you're either writing a purchase agreement or accepting a purchase agreement on your property, another component of the real estate contract that you're going to be presented with is an arbitration agreement. The Minnesota Association of Realtors has decided to partner with NCDS, National Center for Dispute Settlement, to provide an optional agreement that you can take advantage of called an arbitration agreement. So at the time of finalizing your contract, you'll also be presented with the opportunity to either agree or not agree to arbitration. There are a lot of questions that come up about this, and people try to understand, what does this mean for me? And I'm hopefully going to try to give you a little bit more information about that. At its core, arbitration agreements are pretty common. If you've signed a credit card bill, a mobile phone plan, or use social media, you've probably already agreed to arbitration in those agreements in relation to whatever that service might be. In this context, the real estate transaction, you have the ability to agree to arbitration as a way to resolve any disputes that might arise after the closing of your transaction. So to be clear, these arbitration agreements don't apply to disputes that if the transaction falls apart. It doesn't apply to title issues that you would maybe work through with your title insurance company. It doesn't apply to new construction warranties, but it essentially applies to post-closing disputes between a buyer and a seller over a condition in the property that is discovered after closing, something material, a major defect or problem. And so the question would be, in your personal situation, would agreeing to arbitration make sense for you? What is arbitration? Arbitration is a alternative to the regular civil legal system. Basic civil legal system is if you're in a dispute with another individual over any civil matter, which would be, a private legal matter, not like a criminal matter, you would take the matter to the local district court, the local county courthouse, and you would probably need to hire an attorney and take that matter through the civil legal system process, which has been a system that's worked for many years, but I'll warn you is pretty expensive and very, very time consuming. And arbitration has been a system that has been promoted by many members of the legal system and judges and other individuals and consumer rights groups as a way to provide a more efficient, less time consuming, and less logistically difficult system to resolve a private dispute. So if you take advantage of arbitration, you are taking advantage of a system that is trying to be more quick, less costly than the civil legal system. If you choose not to take advantage of arbitration, you can still always resort to the civil legal system in the courts. There's a few things in this arbitration agreement that you should be aware of. Number one, this arbitration agreement refers to a barrier of $15,000. And I want to make very clear what it's saying is that if you have a dispute with the other party after closing and the amount is less than $15,000, this arbitration agreement says that you will just take the matter to small claims court, which is a local version of the civil legal system, but it's designed, like arbitration, to be simpler, less expensive, less time consuming. So a small claims court or conciliation court would be the place where you would take that dispute if the amount in dispute is less than $15,000. If the amount in dispute is more than $15,000 and all parties have agreed to this arbitration agreement, then they would take the matter to arbitration. And that process is spelled out in the agreement itself. We would bring it to the company ncds.org and go through their system with their rules to bring your claim and for it to reach its resolution. You're allowed to have an attorney represent you in arbitration. There's rules that are involved in that process as well. It's still a relatively formal process. It's just less formal and less time-consuming than the regular legal system in the county district court system. If any party doesn't agree to the arbitration agreement, then it's not binding on anyone. But if all parties do agree to this arbitration agreement, all parties being the buyers, the sellers, and the realtors representing them, then if there's a post-closing dispute, if the matter is worth more than $15,000 in alleged damages, then the matter would be taken up in arbitration, and you would simply go through that process for reaching a binding decision on the result. Now, I know the question that everyone asks is, well, should I do this or not? And frankly, it's a decision that you have to make for yourself. You can certainly consult with your own legal advisor or attorney to ask their input on this, because the fact of the matter is we can't tell you if it's going to be the best result for you or not. It's impossible to know at the time of signing a purchase agreement, which is the time when you'd sign this arbitration agreement. It's impossible to know, will signing arbitration or will declining arbitration benefit you? Will it not benefit you in the long run in some future hypothetical legal dispute at a certain point into the future? The question can't be answered. All that arbitration does is try to set different ground rules for how a dispute will be resolved. And the idea behind arbitration is, again, it's designed to be less costly and more efficient, and ultimately to reach a binding resolution on a legal dispute. So I hope this information is helpful for you to help try to navigate this particular question. Just understand that if you do not feel comfortable in signing arbitration, you are perfectly free to decline it. And at that point, in any future legal decision, all of your options would still be on the table. The one that you're just simply not agreeing to is the arbitration option. The next topic I'll talk about are contingencies in the purchase agreement. Contingencies in a contract are clauses that are included that trigger some sort of right or option in one party to a contract during the course of the contract. The most common contingency that we would typically see in a purchase agreement, one of the most common ones, is a financing contingency. And that essentially means that since many buyers of homes don't have the proceeds to just purchase a home in cash, and instead they require the assistance of a bank to fund their purchase through a mortgage. The financing contingency says that if the buyer is unable to obtain financing, they would have an opportunity to exit the contract because, of course, they're not able to get the funds from the bank. That's one such contingency. Another contingency is often in real estate transactions, the home buyer is moving up from one property to another. So they are selling their current home and then they're purchasing the next one. And it is an option to include a contingency that's essentially creating a domino effect where the sale of the buyer's current home is a contingency for the next one. But the contingency I really want to talk about today is the inspection contingency. It is one that is been relatively common in contracts for a number of years. However, it's becoming more common, it seems, that buyers are choosing to waive their right to do an inspection contingency. In large part, it appears that it's because in a competitive marketplace where inventory is a challenge, it is sometimes a necessity, or there's a feeling that by waiving the inspection contingency, it makes your offer more marketable. And this video really can't comment on the state of the market. That's something that you can discuss with your sales executive as you decide how aggressively you want to pursue any particular home or the negotiation of a contract. Conducting an inspection contingency is an extremely important opportunity in a real estate transaction. An inspection by a professional inspector is incredibly important because you're making a very, very large investment in a piece of property that you've really only spent typically a very small amount of time. In the normal life of a real estate transaction, the amount of time that you as a home buyer will spend in the home that you're about to purchase are minutes or less than a few hours, right? Attending an open house, walking through the home at a showing, it is typically a relatively short amount of time and very likely does not involve the detailed and thorough inspection and analysis and observation that an actual home inspection involves. A home inspector will spend hours, depending upon the size of the home, hours in the property, going from room to room, deliberately looking essentially at each corner of the home and looking at testing the appliances, the sinks, the faucets, the showers, all the things to really determine the working condition of the home. And so it's a really important part of the due diligence process when you're buying a property, because the property had been used previously by someone else, and how they done to the property deserve a second look. So it's really, really important that you strongly consider your options when you're purchasing, and you really understand the risks that you make in choosing not to do an inspection, because choosing not to do an inspection means you are essentially relying only on your own visual observations on a limited basis of the property. And it may be that by purchasing a property with no inspection, it may mean that if you discover issues after closing that you weren't aware of, or problems after closing, or certain things about the home that you weren't aware of and that you are not particularly happy about, it may be that the choice not to do inspection means that you are now responsible for that condition, and you have to accept the reality that if you're going to need to fix it or change it or do whatever, that is now your responsibility to address and pay for. So please understand that waiving inspection contingency is a pretty significant decision, and there are alternatives, and you can talk to your real estate agent about what other alternatives might exist for you to try to defray or reduce the risk of choosing to waive your inspection. The last thing I want to talk about is taking title in your real estate transaction. At the closing, at the sale or purchase of a real estate transaction, the property is conveyed via a written instrument known as a deed. And there are two components that I want to discuss regarding taking title in a deed or conveying title in a deed. The first component of taking title or conveying title in a deed is understanding the different types of deeds that exist. And in essence, there are three main types of deeds that can be conveyed at a closing. There's a general warranty deed, there's a limited warranty deed, and we'll talk about the different types of those, and there's something called a quitclaim deed. Now, a general warranty deed is a deed that has basically the highest levels of protections for a buyer when they're acquiring a property. In a general warranty deed, essentially, the seller, the grantor of the deed, the seller of the property is warranting or promising in that deed that they possess clear title and that they are conveying clear title unencumbered by any other adverse ownership interests in the property for themselves as they're giving it to you, and for anyone else, any prior owners of the property. They're essentially saying, as a general warranty, that this title is good and this property is now passing to you with that additional promise or assurance, if you will. The quitclaim deed simply just says whatever it has no warranties at all, no promises at all, no assurance at all. It essentially just says whatever interest that exists, here you go. The quitclaim deed is sometimes called a problem solver's deed. It is a very bare bones, essentially very limited deed whatsoever. And in the middle of those two opposite ends of the spectrum is something called a limited warranty deed. And that is a version of a deed, sometimes called a special warranty deed. Also, There are types of warranty deeds that are referenced in the purchase agreement that you might have come across, including a trustee's deed or a personal representative's deed. These are all versions of a limited warranty deed, which again is somewhere on the spectrum between the general warranty deed that has all the protections and a quitclaim deed that has essentially none. A limited warranty deed is a limited amount of warranties that are only applicable to the extent that property was owned by the grantor. And let me explain. A trustee's deed is used if a trust is selling a piece of real estate. And the trustee is the person who's authorized to sign on behalf of the trust. And the trustee's deed would essentially be saying that as the executor of the trust, I warrant that to the extent that the trust has owned the property and I've been in charge of it, the title is good because I haven't deeded it to anyone else. I haven't let anyone else buy this property. I haven't, encumbered the title in any way, but only in relation to my role as trustee. I can't promise anything else in the past. I can only promise about what I know since I've been in this role. Similarly, a personal representative's deed is used if a person died, the homeowner died, and through the probate process, a personal representative has been appointed to, administer the estate. And the personal representative deed is essentially saying, to the extent that I've been in charge of the estate as personal representative, I can attest and promise that I have not conveyed title to anyone else or created any title issues. But in both those cases, the personal representative and the trustee, they can't promise anything else other than what they know. It's a limited warranty deed. If the property is being sold by a trust, if the property is being sold because as part of an estate and the prior owner is deceased, you will have to convey with a trustee's or personal representative's deed because that's just the nature of that particular situation. But here's the good news. If you're concerned about warranty deeds or limited warranty, by the way, even if it's a general warranty deed, I'm still going to encourage you to get title insurance. But if you're concerned about a limited warranty deed or a quitclaim deed and thinking that the lack of a full amount of warranties is a concern for you, then the best solution is to just obtain a full title insurance policy. Because at the end of the day, the title insurance industry exists as a way to offset for the risks of title issues and to provide you with an actual insurance policy that in the event that an issue is discovered, you can simply notify the insurance company and they will take up the issue. They will pay the legal expenses to clear up the title. So if you have any concerns about the type of deed that you are receiving, you should very strongly consider title insurance as a component of your purchase. You may also work with your own your closing company or your own attorney to review the title that's provided to you in the closing process, to review it in detail to make sure that you're comfortable with the history of this document and everything else. But title insurance, by and large, will offset any risk that's posed to you if you are purchasing a property and have any concerns regarding a limited warranty to trustees, personal representative's deed, or a quitclaim deed. Now, the last issue I want to talk about is when you're taking title under any one of those types of deeds, what happens if you're buying with another person? So this really part of this last conversation, if you're a single person purchasing a home or if you're a single entity purchasing a home, this part of the conversation doesn't apply to you. But if you are buying a home with a spouse, if you are buying a home with another individual and you're purchasing it together as two separate individuals, whether you're married or not, separate individuals, it's not as if you're buying half the house and they're buying the other half. You're both buying it, or you're all buying it one property together. And when you do that, you're given essentially two options: joint tenancy or a tenancy in common. A joint tenancy means that you're buying equal interests in a property, number one. So if there's two people, you're each buying an undivided one half in the property. If there's three people, you're dividing an undivided third apiece. And when you purchase in a joint tenancy, if you're buying it with two people and one person dies, the interest in that property will automatically vest and transfer to the other person. So a joint tenancy is essentially a situation that avoids probate, estate planning, or other things of that nature if in the event of someone dies, where automatically if your if you're a co-owner of a property and you die, your interest, your undivided 1/2 interest, automatically just goes to the other person, and they now become the sole owner of the property, with no need to go through probate, no need to have any sort of separate estate plan in relation to that piece of real estate. The alternative to that is called a tenancy in common. And if you don't elect to have a joint tenancy, where your interest would automatically go to the other co-owner, or vice versa, their interest would automatically come to you upon their death, the other option and the default option is tenancy in common. And in a tenancy in common, that automatic transfer of your interest to the other person, called the right of survivorship, does not exist. And so what that essentially means is that if you're purchasing a property and hold it in tenancy in common, if you were to die, then your estate would own that undivided 1/2 interest of the property, and that undivided 1/2 interest of the property would be bequeathed or transferred or distributed to your heirs, whoever those might be, which might be, by the way, the other person, the other that you purchase with, but it all depends on your own personal estate plan. Often a married couple, they're purchasing together, and their estate plan is that the other person, the spouse, will get everything anyway. Certain people have different objectives in their estate plan and other things. They would prefer to leave their interest to other people, children, what have you. And so you really probably, if you have a unique need in regards to your personal estate plan, as you're approaching the closing, you should probably consult with whoever assists you in creating your estate plan to determine which is the right route for you and which type of deed you might want to choose. But if your estate plan is essentially that you want to, your spouse, what's mine is yours and yours is mine, right? If you want your spouse or that other co-owner of the property to have your interest in the property if you were to die, and vice versa, that is what a joint tenancy deed is. If you're not sure, you don't have to choose the joint tenancy. You can choose to take title as tenants in common. And by the way, you can always change that in the future by essentially changing the deed. So if you change your mind or want to do something differently, you can fix it later. But for the purposes of as you're approaching a closing, this is part of the conversation that you need to have with your co-borrower, if you have a co-borrower co/co-buyer, about how we're taking title and what would happen if the unthinkable happens, one of you were to die. Hope this information has been helpful for you. Obviously, again, if you have further questions, you can certainly consult with your sales executive or your own legal advisor or attorney. And thank you again for choosing RE/MAX Results.